Dina.
Well, an expanding Democratic race indeed ahead of those 2020 elections. Thank you, Bloomberg's Sahil Kapoor. And during the partial government shutdown, Commerce Secretary Wilbur Ross suggested that furloughed workers could just get a loan. In fact, there is a $90 billion industry that does focus on making expensive loans to Americans with limited options who are desperate for cash. Adam Tempkin covers structured finance for Bloomberg News. You join us now. Sort of break this down for us. What is it? How big is the industry? How legal is it?
Well, basically, this is a $90 billion industry, 16,000 storefront lenders, and many, many new online lenders. And these are ultra-high-cost loans for subprime and non-prime borrowers. The lending industry says there is a need for this. There's a need for these people to have access to credit when traditional banks do not offer it. The problem? Interest rates, 200%. 450% annually, but they say there's a risk to these borrowers. That's why, in order to be profitable, they have to charge that much.
450% interest rate seems mind-boggling to me, and I think of what happened in the United Kingdom recently, where they've put caps. Basically, yes, you might have to pay a 450% interest rate, but the minute you get to the size that you've borrowed, in terms of fees, in terms of interest rates, it's stopped, it's capped. You can't keep on paying forever. What about the regulatory impact here in the US? Because it almost feels like there's some pushback. We're seeing an openness to these sorts of payday lenders rather than the regulation we're seeing in the Obama era.
Well, I should say that only 34 states actually allow payday lending. But now there's other types of products called installment loans, which is a payday loan. You get more time to pay it off. And believe it or not, it's not only what you'd think less creditworthy borrowers. We were told, surprisingly, professionals, college-educated people, they don't have cash on hand. Yeah. They go to this, and this is what they call the new middle class.
Well, and as Caroline was mentioning, we're sort of in this era of deregulation. I mean, that was a big part of President Trump's election. In comes the Consumer Financial Protection Bureau. You say that they're starting to roll back, I guess, some of these protections for these borrowers. Where do they fit into this?
Well, the CFPB earlier this month did a huge about-face with the new Trump administration. Basically, they had a rule, an Obama-era rule, that would have put into effect this year, basically taking, really eliminating a good part of the payday lending industry. Lots of lobbying happened, and a few weeks ago, now there's a proposal out by that same CFPB to gut that rule, especially payday lenders, this ability to repay. They don't want to have to figure that out, because if they do, it'll cost more money. And they say there won't be any payday lenders left, and there's a need for them.
There's clearly a need. There's clearly periods in people's life where you need some extra cash on hand. What about filling the gap by the actual banks themselves? Surely there's got to be some sweet spot where the interest rates aren't so horrendous, but equally they're able to offer these sorts of loans with getting the right amount for the risk that they're taking on.
Interestingly, payday lenders say they have to have this business model because traditional banks do not offer these small dollar short-term loans. That may be changing. The Fed put out guidelines this past year, and U.S. banks started with this, it's called a simple loan, and they say they could undercut the payday lenders by 6 to 8 times. So this is new. Traditional banks slowly getting into the business, maybe for a lower interest rate than payday lenders, more competition.
The positive feedback loop of disruption, sometimes it can be in everyone's benefit. Thank you very much indeed. Great analysis from Adam Tempkin, who covers structured finance for Bloomberg News. Now coming up, California leading a coalition of 6